Good morning, ladies and gentlemen, and welcome to the show on this Thursday, the 19th of August, 2021. Thank you for tuning in. Now, I'm going to tell you guys what. It's like the Fed. It's like they never learn their lesson. Again, now, they're going to taper into extreme weakness. They think they're tapering into strength. But the money is running out of the... Money, I shouldn't say money. Currency is running out of this sieve, or drying up faster than... And so, in actuality, even though the numbers are up, because it's been like a flash flood of money and it's buoyed everything. So it's up, everything's up. It's draining out fast. And now they're talking about tapering. Let's get right in there and let's take a look at what's going on. Let's open up the charts right here and take a look at these FOMC minutes. They see... The Fed members are pretty much in agreement. It says most Fed members see the taper starting this year. This year. It says they're saying that substantial further progress has not yet been made, but most see conditions are being met later this year. What they're setting up for, guys, they're setting up for something called disinflation. We're going to run right smack into. And we're going to start running right smack. Well, okay, first I'll explain what disinflation is. Disinflation is when you got a rate of inflation like we've got now. We've got a fairly high, substantial rate of inflation. And that starts to be less inflation. Like, it's disinflation. It's not deflation, which is when there's no inflation and the prices are dropping. Disinflation is when the prices are not going up as fast as they were. That's disinflation. And that's what we're headed toward, a cooling of this inflation. And in fact, I'm going to tell you guys what. If the Fed tries this on, and it looks like they're going to, we could actually be in for some real deflation. Everything can change in a heartbeat in this economy because the Fed is starting to decide to taper here into weakness. It says the FOMC July meeting minutes provided a dovish offset from the hawkish Fed speak that has been heard recently. The minutes suggested that participants generally judge that the standard of substantial further progress has not yet been met, particularly with respect to the labor market conditions, and that risks in the economic outlook remained, although most judged that it could be appropriate to start reducing the pace of asset purchases this year because they saw the committee's substantial further progress criterion has been satisfied with respect to price stability goals as close to being satisfied with respect to the maximum employment goal. So they're thinking that everything's fine right now and that they can start tapering back. Big mistake. Everything is not fine. What we've seen is during this crisis, they've pumped the system full of money, but the money's went in all the wrong places, and now it's drying up really fast. We also see that the unemployment out there is not what they're making it out to be. In other words, there's an awful lot of people that are not counted. They've just basically give up looking for work. And when I say an awful lot, I'm talking about unreasonably high numbers of these people. Can't find a job, So what they're doing right now is whenever they pour money into the system, they're actually pushing on a string. Their money's not going anywhere. The system, like I say, has become a sieve. And on the other side of that, it dries up quicker. The system wants to flop now between inflation and deflation. We're riding a very fine line. And so the Fed's now talking about tapering. We're not going to make it till Christmas, guys. We're going to have a crisis event in the markets. And we might be entering into it now. But this is going to cause a sea change in the Fed that hasn't occurred yet. An about face Right now, they're thinking to themselves they can do this. It's not going to be proven they can't do it until they try to do it and they fail. Then that's going to bring about a complete 180-degree turn of the Fed to a very dovish stance again. When that happens, that's when we have to wait until after that happens. You see? After that happens is when we're going to start to see the really profound inflation. You guys haven't seen nothing yet. That's when gold and silver are going to take off. Is after we clear this out. We have to clear this out first. We have to prove the Fed wrong. That they're living in a fantasy world. Okay, let's move on and take a look at the price of gold today. Now, see, this is part of this fantasy world that they're living in right now. With these low prices for gold. It's down even $6 today at $17.82. This is going to be busted. This whole thing's going to be busted wide open. The Fed has a picture in their mind that they're in control over the complete control over the system. They're going to find out that the markets are more in control than they think very soon. Boy, I'll tell you, what a situation. So we're going to move into some disinflation and possibly even some deflation. And it looks like it's coming before the end of the year. This whole sea change might happen before the year's out even. What I mean by sea change for the Fed is a complete about face. They're going to yield to this situation. They're going to be forced to yield to it. That's basically what I'm saying, by a crisis. A crisis in the markets. And, well, we've seen we've seen the markets, rumblings in the markets, generally before a big earthquake oftentimes, or a big volcano, the ground will rumble a lot. Well, we've seen that in the markets, turbulence in the markets. Markets would fall off for a few days or even a week, and then it would pop back up again. And we've seen that happen 2 or 3 times in the past number of months. And now we're seeing the markets decline, but this time I think it's different. This time is going to continue. I think it's going to, I'll tell you, I think we're starting right now. I think we're getting into it. And I think the markets are going to continue their decline. Maybe a few up days, but more down days than up days. And as it starts to deepen, as we move later, and if they start to pull out more of this taper talk later this year, we could be looking at some pretty rough market conditions before the end of the year that could force the Fed into changing their complete stance. But I'm going to tell you guys something else. Now, here's a key piece of information for you guys. I know an awful lot of you guys out there are betting on interest rates going up. And normally under these kind of circumstances we have right now, the rates would already be gone up. Like the 10-year, the 30-year, already they would be rising and really high right now. They're not going to let them go up. If the Fed has to, they'll do yield curve control. And the reason why is they can't afford to let the rates go up. Even though we got inflation, we're still going to be looking at historically low interest rates. Doesn't matter how high the inflation gets, too. And so I know an awful lot of you guys are saying, okay, we're going to head into hyperinflation, massive inflation. Interest rates are going to go up. Well, that's what should happen. But we're not living in a normal world. We're living in bizarro land. And interest rates could actually go down. I mean, it just doesn't make any sense. But if you guys are betting on that, well, you better think twice, Okay, so we're looking at gold price of $17.83. Let's just take a look here at silver. Silver price is $23.25. Yeah, interest rates could go up a little bit. Like the 10-year could probably go as high as 2.25. Maybe even 2.5 before they put the clampers on it. They're not going to let them normalize, guys, is what I'm trying to say. And normalize right now, considering the amount of inflation we have, to normalize interest rates on the 10-year, you'd probably be looking at 7 or 8%. Just forget it. That ain't going to happen. Because they wouldn't be able to service the debt if they let interest rates rise. For one, that's just one reason. Okay, it would just blow the whole economy apart, basically. Is another big reason. Okay, so let's take a look now at silver. It's down 21 cents. They're putting this on sale for you guys right now. If you're smart, you'll be taking advantage of it. You know, if it's a, and listen, guys, don't buy the SLV or GLD. Cryptos today, 1,946 billion. Now let me refresh the page and see if it's static. No, 1952. So we're going up right now. 45,724 for Bitcoin. But the money's flowing in right now, and the thing is Bitcoin's not moving up very much. Means an awful lot of this money is pouring into the altcoins right now. So altcoins are going up is a bullish sign for cryptos. It always has been. That's bullish when the altcoins go up. And when Bitcoin goes up and the altcoins go down, that's a bearish signal in the Bitcoin market, as far as I'm concerned. But so right now we got the green light on cryptos. How long will that last going into this deflation? Well, not deflation, disinflation. I don't think it's going to last very long. And it could set up for a buying opportunity in the cryptos when we're at the peak of this disinflation. It could actually turn into deflation. We're at the peak of that. You could have your best buying opportunity for cryptos that you're ever going to get, because cryptos is the way. That's where everything's going to head. It's heading into cryptos. Cryptos is already massive. I can only see it, unless I can't see what would really stop it. Bitcoin is actually its Achilles heel. If something maybe were to happen to Bitcoin, where Bitcoin were to freeze up or something. But, you know, it's been around since 2009. It hasn't frozen up yet. So, if it continues, crypto continues, it's going to win in the end. Dow Jones Industrial Average is down 18 points on the day. Refresh the page here, 18.99 at 34,941. But I would just say that this market is just peaked now, and it's wanting to turn bearish over the next few weeks. You know, as long as the money keeps running out and drying up, and as long as the Fed keeps talking about tapering and stuff. Let's take a look now at the oil. Oil's down $2.60 or 3.97% to 62.86. That's quite a big drop for oil. You might actually see that translate to the price at the pump, because it's quite a big drop. Maybe 5 or 10 cents at the pump. Let's take a look now at the MOVE index. 58.05. And we're down 14% on the day. Now let's take a look at bonds and rates. And what we're looking at is falling yields. We're looking at 1.23 on the 10 years. Fell 3.6 basis points, which is quite large. In the 30 years, 1.87, and it's fell 3.9 basis points. But the yields are falling all the way across the board. Not so much on the short end, but more on the long end. Let's see, which one's got the highest fall? It looks to me like the US 20 year. It's fell 4.2 basis points today at 1.79. We're going to take a look at the US dollar index. And we're looking at 93.4. And it's going up today, but it's kind of like more sideways than it's went up earlier, and it's been going along sideways the rest of the day. But 93.4 for the DXY. Thank you guys for listening to my show. Like and subscribe, and we'll catch you guys in the very next episode. Bye-bye.